Okay, today we will discuss about inventories chapter. So the first is how to control inventory. The first step of controlling the inventory is safeguarding the inventory from damage or theft and reporting inventory in the financial statement. Next. The following documents are often used for inventory control is purchase order, receiving a report, and a vendor's invoice. Okay, next. The purchase order is authorize the purchase of the inventory from an approved vendor, and the receiving report establishes an initial record of the receipt of the inventory. Next. This is the example how to safeguarding the inventory. First, the company need to storing inventory in a restricted area, and the second is locking high prices inventory in cabinets, and third using two-way mirrors, cameras, security tags, and guards. Okay, the next is reporting inventory. To make sure that accuracy of the inventory quantity, the company need to make a physical inventory. The physical inventory or count of inventory should be taken near year end. Okay, next. Sometimes the company sells same merchandise with different price in the different period. Here the problem will occur. So the company need to make inventory cost flow assumption. Next. The cost flow assumption first is cost flow in the order in which the costs were incurred, and second is cost flow is an average of the cost. The inventory costing method, the first is we can use in FIFO or first in first out step, and the second step is weighted average cost. Okay, next. This is the example. Assume that 3 identical units of merchandise are purchased during May as follows. And then next. And this is assume that unit is sold on May 30 for 2,000 rupiah. So the ending inventory, we need to add the average for the same unit sold.
The specific identification inventory cost method. The unit sold is identified with a specific purchase. Second is the ending of inventory is made up of the remaining units on hand. That was the example. Next, please. First out, inventory cost flow method. In the FIFO, which means that the inventory that is first entered is the first to be recorded as goods sold. The first unit purchased are assumed to be sold, and the ending inventory is made up of the most recent purchases. Next, please. The weight average inventory cost flow method. The cost of the units sold, and in ending inventory is a weight average of the purchase cost. Next, please. So as we can see, this is the inventory costing method. You can see the FIFO method and the weight average cost. Uh, let's see. Next, please. This is the inventory costing method under perpetual inventory system. This for the example. Next, please. So this is the step to make first in and first out method. The first step is costs are included in the cost of merchandise sold in the order in which they were purchased. It is often the same as the physical flow of the merchandise. The third is if often provide results that are about the same using the specific identification method. Next is this is the journal entries and perpetual inventory of FIFO. Next, please. Weight average method. Weight average cost method. This is the step under a perpetual inventory system. A unit cost for each item is computed each time a purchase is made. Second, to determine the cost of each sale unit, another purchase is made and a new average is computed. The third is technique. This technique is called a moving average. Next, please. This is the entries and perpetual inventory account for the weight average. Next. So inventory costing method under a periodic inventory system is only revenue recorded each time a sale is made, and no entry is made at the time of sale to record the cost of the merchandise sold. And a physical inventory is taken to determine the cost of the inventory and the cost of the merchandise sold. First in, first out method. We use the sample as you can see in the slide.
First in, first out method. First is the bicycle count on January. This is the example of first in or first in, first out method, or we usually call it FIFO. In most recent costs at January, for about 600 units, at 23,300, the total is the units multiply the cost. So the total of most recent cost in January of 30, first in, first out method, the cost of merchandise sold of 26,000 and 7,700 and 20,000 as shown below. Beginning inventory at January 20 billion and purchases 111 plus 13 blah blah blah. The total is 25 blah blah blah. Cost of merchandise available. This is the example of merchandise sold. And we see here that purchases in January about 1,000 units, and at 10th of January 500 units, and 30th of January 16 units, and also merchandise available for sale multiply the purchases, and the total is in the blue table. And then weighted average cost method. Just now we learned about FIFO or first in or first out method. And here we learn about weighted average cost method, or usually we call it WA atau WA, and how to find the answer by weighted average unit cost, total cost of units available for sale per units available for sale, and the data for item blah 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 until we got 21,510 per unit. And this also about the example. And in this slide, we compare inventory costing method. First is FIFO and weighted average inventory normally filed in different amounts for the following. First is cost of merchandise sold, and the second gross profit and net income, and the last is ending merchandise inventory. And here, when we use the perpetual inventory system, we put sales and cost of merchandise sold, and also gross profit merchandise inventory. But effect of changing costs, FIFO and WA cost methods, and this the differences between them.
Okay, I will explain about reporting merchandise inventory in the financial statement. So cost is the primary basis for valuing and reporting inventory in the financial systems. Inventory may be valued at other than cost in the following cases. The first one is the cost of replacing items in inventory is below the recorded cost. And secondly, the inventory cannot be sold at normal prices due to imperfection, style changes, spoilage or loss, damage, obsolescence. It is when the thing is no longer used, so it is become, the quality is loose, and then other causes. Next, valuation at lower of cost or market. If the market is lower than the purchase cost or lower of cost or market, or LCM method is used to value the inventory. And market as used in lower of cost or market is the net realizable value of the merchandise. Net realizable value is determined as follows. Net realizable value equals to estimated selling price minus direct cost of disposal. Direct cost of disposal include selling expenses such as special advertising or sales commissions. And the next slide, valuation at lower of cost or market. Assume the following data about an item damaged merchandise. The first one is original cost. It is 1 million rupiah, and estimated selling price 800,000, and estimated selling expenses 150,000. In applying LCM, the market value of the merchandise is 650,000, computed as follow. Market value or net realizable value equals to 800,000 rupiah minus 150,000 rupiah equals to 650,000 rupiah. Thus, the merchandise would be valued at 650,000 rupiah, which is the lower of its cost of 1 million rupiah, and its market value of 650,000 rupiah. Next slide. Valuation at lower of cost or market. The lower of cost or market method can be applied in one of three ways. The cost, market price, and NED lines could be determined for the following. Number 1, each item in the inventory. Number 2, each major class or category of inventory. Number 3, total inventory as a whole. Next slide. Merchandise inventory on the statement of financial position. Merchandise inventory is usually reported in the current asset section of the statement of financial position. The following are also reported. Number 1, the method of determining the cost of the inventory. It is FIFO or weighted average. And secondly is the method of valuing the inventory or cost or the lower of cost or market. And the next one is merchandise inventory on the statement of financial position. Here we have the example of Kedai Kopi, December 31, 2016. The following information is about the current assets. The first one is cash and cash equivalents. It is reported that 235 million rupiah. And then trading investment at cost, it is reported that the number is 420 million rupiah. And then the next one is plus valuation allowance on trading investment. It is 45 million, and in the credit it is 465 million. And the next one is accounts receivable. It is reported that it is 305 million rupiah. And the next one is less allowance for doubtful accounts, 12 million 300,000. And then 292 million 700,000. And then merchandise inventory at lower of cost, first in first out method or market, 120 million rupiah. The next one. The next one is effect of inventor's errors on current period's income statement. So here's the information about income statement effects. In inventory error, there is beginning inventory and ending inventory. The first one is inventory error. At the beginning, inventory is understated and then overrated, and ending inventory is understated and then overstated. And then cost of merchandise sold, at the beginning of inventory, it is understated and then overstated. And in the ending of inventory, it is overstated and then go back understated. For gross profit, at the beginning of inventory, it is overstated and then become understated. And at the ending of inventory, it is understated and then become overstated again. And about net income, at the beginning of inventory, it is overstated and then go understated. And at the ending of inventory, it is overstated and become understated again. The next one is effects of inventory errors on 2 years of income statement. So in the table, there is some information about the income statement of the company of Sinar Express. There is sales, merchandise inventory, purchases, merchandise available for sale, and less merchandise inventory. And then cost of merchandise sold, gross profit, operating expenses, and net income. And net effect is 0 for 2 years. The inventory errors reverse for or cancel so that combined net income for the 2 years is 525,000 rupiah is correct. Next.
Siapa? Siapa dah? Dia nggak kedengaran.
Bukan Afdal ya aku. Siapa? Afdal nggak sih? Aku sampai nomor halaman 40 kan?
Itu terakhir.
Ini yang terakhirnya. Sebentar ya. The next one is effect of inventor errors on current period statement of financial position. Here is in the table, there are statement of financial position effects. At the ending of inventory error, it is understated and then go overstated. And in the merchandise inventory, the first one is understated and the second one is overstated. And in the current assets is the first one understated and then go back overstated. Of the total assets is understated and then go back overstated. And the owner's equity or capital, the first one is understated and then the next one is overstated. Okay, next.
Next, financial analysis and interpretation. That this statement we can get the conclusion. There must be stock left, not too much and not too little. Next. We have one of method to analyze inventory. Is inventory turnover. Is one way that you can measure the effectiveness of sales that have been made based on the stock of good we have. The formula that is inventory turnover, cost of merchandise sold divided affect inventory. Next. In this we can see PT Matahari Department Store to BACC in the 2060 and 2050. The beginning of year plus end of year divided to we got average inventory. We follow the formula cost of merchandise sold divided average inventory and we got inventory turnover in 2016 3.7 and in 2015 we got 3.4. Next method to analyzing financial ratio. We use number of days sales inventory. That's main financial ratio that show the average time it takes a company to convert inventory, including goods being produced, into sets that we can divide it by day in 1 year. 365. Formula is number of day size inventory. Average inventory divided average daily cost of merchandise. Next. We can see the formula. The first step we use cost of merchandise divided day in 1 year. We got average inventory. That's same formula with step of inventory turnover method. And next, number of days sales inventory we got from average inventory divided average daily cost of merchandise. So we got in 2060 99.2 days, and in 2015 we got 107.4 days. Next. This is example inventory turnover and number of days sales inventory from Matahari and Bata. And in these slides, we can get conclusion. The good firms the best inventory stability inventory and have stock good in 1 year. That's we got in Matahari. Matahari best by from Bata. Matahari have best control inventory turnover and number of days sales inventory, because inventory turnover big from Bata. That is number 3.7. Next. For estimating inventory cost, we have two method, retail method and gross profit method. Next. Retail method of inventory costing, that is, we have 4 steps to estimate inventory cost with retail method. Retail method mean eceran step dengan menggunakan cara eceran. That's we can usually use from by supermarket, like supermarket. Next. This example determine inventory by the retail method. Next. The last one method to got inventory costing, that is gross profit method. That means we use this method, we want to see how much harga barang pokok. This step we use to see barang mentah. Next. And this is example to get gross profit method. We can follow first step to got this journal to get gross profit method. We can see how much inventory costs in 1 year from the firms. That's all from me. Thank you.